And an interesting part of this, because this brings me to like the way I always look at banking profitability on a super high level is at the end of the day, any profitability, whether it's bank or whatever, is always revenue minus cost. Well, let's leave the revenue side of the equation a little bit, but look at the cost side of the equation. And if you look at banking, for me, it's always like threefold. One is the default risk. If you have a loan and you don't get it repaid, that's definitely a cost. Then
Yep.
second is the cost of money. I mean, you have to get
Yep.
money in to be able to lend money out. So that's the cost of money. And but third is then the operational cost. And when we talk about this whole switch from branch to digital, that is a big difference in operational cost going on. So that's a very logical discussion to tend towards. But how would you look at the other two elements like default cost and money cost? Because if I talk especially to like the sales guys, they say, oh, the operational costs don't matter, which I think, and we'll get back to that later, they matter a lot. But just for us to understand a little bit, I'd like to hear your view on the other two.
Yeah, and I will give the benefit of the doubt to the people who say the operational costs don't matter. More, it's the operational cost. Most banks, when you talk about their operational costs, they're going to say, hey, we have engineers in who study these things to make things the most efficient. It's more tangible and it's more controllable. They set their budgets, they set their staffing levels, they can make the adjustments, they can control that, so it becomes a little bit more tangible. So I don't think they say it doesn't matter. We've been dealing with this for decades on decades of understanding and managing these things. When you get to the cost of capital and you also get into your risk, that is where the concern comes, because there are market factors that an executive at a bank can't control
Exactly.
on their profitability. Right now, from a cost of capital, and part of it's set by the Fed, where you have your interest rates. And for the most part, there's people who study that and they can understand where things are going in general. But the market does set the yield curves, and has impact of that beyond just your prime rates in the market. And the market becomes something that becomes a little bit more intangible, a little bit more vague, because there are plenty of factors that play into what your curves are for your cost of money. And then when it comes to your risk of your loans, once again, you're dependent upon the risk profile of whomever your customer is that you made that loan to. And so we look at this post-pandemic situation, and the retail space that is open, or the commercial space for leases where people have still worked from home, and you have all the vacancies in all of these large cities with all these buildings. There's a risk there now to the banks about something that was beyond their control, that now they get more concerned about, because that, the cascading impacts of default on loans for commercial properties is a legitimate risk in the future. And so understanding what their exposure is, understanding what would happen and what they can bear, and their ability to proactively get in front of that risk, as well as understanding how much they can handle, and then, or just what their exposure is very important when it comes to profitability measurement and management, and understanding that true impact. And so I think that's probably what they mean more when they say they don't care about, or they got the operational side under control. I think they do care very much, but it is, when you look at your largest risk or your largest uncertainty, it's in those two areas where they have less control.
I totally
And so
agree.
a key to a good profitability model isn't, we can't solve all those issues. A profitability model cannot tell them what's going to happen to their loan portfolio and where they're going to have larger defaults or not. What we can do is measure it, and then apply some predictive thought into it about if trends hold or if things change, to allow them to be a lot more proactive in their management decisions.
Yeah. And if you look at your history and your background of building those profitability models, I tend to agree that indeed, just because of the fact that operational costs are the only ones that you have the most influence on, I tend to see, and I think that's correct, that most of the profitability models tend to be around that area of operational cost. And even within that area, there are so many left and rights to be taken, and the granularity level that's in there. What's your reflection on these kind of models? I mean, I know you've seen a lot.
Yeah, and I would agree with that. There are very few organizations that we've come across that don't have at least some sort of baseline of measurement of their cost. models or their cost profile, or and maybe what we do find a lot of times is operationally there is a pretty good understanding, because that's where you get the process engineers that come in and you look at all of the things operationally. But when you come to the areas of support, that is where now you become more vague, or there's less science behind what those models look like.
So like the service
Yeah,
centers of finance, IT, HR, those elements. Yeah.
those elements, same with things at just the management of the product chain. So when it comes to your product sales managers and your strategy groups, and those things, that the people on the front line of coming up with the future of how understanding the true cost, to that research and development, in other words, for a manufacturing or a pharmaceutical company. And because that is a big portion, if everybody stands still, eventually you're going to get passed. And so it's that investment into the future, and understanding that impact of costs is important as well. And that's where we do see that a lot of organizations in are lagging when it comes to what they could be from a modeling perspective. As I said, I've very few organizations we walk into and we say, hey, what does your cost model or your cost structure look like? And they look at it and say, we don't have that. Most of the time we have it, but hey, it's really good over here. We go down to very good time tracking. We understand in the branch network how many customers came in, how many individual bills that a teller processed. They know those things. But then when it comes to, like I said, how much does your digital banking platform or network cost you? It's not quite sure.
It's gonna be a little bit more
I can tell you
silent.
what our software license is, and that's about it, right? And that is where then the models, and coming in and doing, and the reason why modeling it becomes important for profitability is to understand those costs, and because you can't truly value the cost of a channel or the cost of a product if you don't truly understand the all-in cost associated with
Yeah,
providing that
let
to customers.